Good afternoon, everyone. My name is Brian Overby, and welcome to Butterfly Breakdown. I am the Senior Options Strategist at Options Play, and this is a continuation from last week's event, or I guess it was 2 weeks ago at this point in time. And today we're gonna make it a little bit quicker show, probably 20 minutes today, maybe 30 if we really dig down into the minutia of complex strategies. But we're today's show is titled Butterfly Breakdown. We're going to look at some butterflies. I'm going to actually run over to the First Trade platform and take a peek at some of the options play tools that will help decide on trades as far as when would I want to do a butterfly, when would I want to do an iron condor. These are advanced trades, and will kind of hold your hand trying to decide if you want to do these trades. And one of the biggest things about the more advanced trades is the underlyings that you're going to pick, that you're going to want to choose to do the trades in. And I think one of the biggest things is, it's always kind of an oxymoron a little bit to me, especially when we get into iron condors, but you want to look at underlyings that have some volatility with some predictability, which is a battle, right? You don't want vols to be so low that there's no premium in the option contracts, but you also don't want them to be so high that there's no way that you can discern where the underlying stock might end up at. So indexes are always interesting for these type of trades. I also like to try to, we have earnings season around the corners. Next week, J.P. Morgan, Goldman Sachs, Johnson & Johnson, all are going to be announcing earnings. So that's really the kickoff of the quarterly earnings season. So sometimes these strategies make sense during those periods of high volatility. And you can lean bullish and bearish with these strategies too, but let's start by just doing a little bit more on the breakdown of a butterfly, because that's the title of this event. And then I'm going to run over and look at a few trades and look at a few things inside the platform. But before we get too far, I already been a little bit long-winded on the intro. I always have to say that everything we talked about today is not meant to be a recommendation, even if we use live securities. Past performance is not a guarantee of futures results. If you're going to trade options, you do need to read the characteristics and risks of standardized options. It's all over the First Trade platform, or any exchange that actually trades options can provide it for you. So we do not give any tax advice overall. And anything that, and I got to emphasize this because we're going to look at a couple of speculative trades, that this is definitely not meant to be a recommendation. We're just trying to learn here. This is all about education at this event. All right. So you have the four basic positions. You can buy a call, you can buy a put. You buy a call, you're bullish. You buy a put, you're bearish. You do the opposite. You sell a call, you're bearish. You sell a put, you're bullish. We're going to combine all four of these trades. We're going to look at different strike prices on each and every one of them. And we're going to make what's called an iron condor today. And we're going to look at an iron condor in an underlying that, we're going to talk a little bit about those underlyings and where you want to consider doing these type of trades. But before we get too far, let's just talk about the butterfly. Let's go back and take a peek at what a butterfly is, and I'll compare this to what an iron condor is, or just a condor in general. Here we're talking about a butterfly with calls. Now here's the biggest difference between a butterfly and a condor is that you're selling, like normally the stock would be trading very close to the middle strike of your butterfly. And if that is the case, then you are selling at the money option contracts, and then you're buying protection. You're buying a call option, if this is with calls, on the downside that will protect your downside. And then you're buying a call option with a strike price that's higher than where the market is at, out of the money, and that will protect your downside there. Now, if you look at a butterfly, it's very interesting at expiration, because the profit and loss graph is, you have very limited and known downside to the net debit that you paid for the trade, but you have a lot of upside at expiration But in order to receive that maximum upside, you need these at the money option contracts, if you're correct on your forecast, to decay. And you need that time value to get sucked away. And that's going to be fairly important with the strategy that I've chosen for you today, that we're going to look at on our trade, because two ways that option contracts can decay, right? If you, I guess decay would be the right word. But the two ways that they can is if you have actual time that passes, time goes by, and the option prices erode, right? That is literally time decay. But also what can happen is implied volatility can change. If the volatility fluctuates and goes down, time premium can go away, especially on at the money option contracts. So around an earnings event, butterflies become interesting because of that scenario. Now, you have two break evens, you still want it to stay within a range, but if you do this trade, that is the way that we would approach it. Now, if I'm looking at an iron condor, and I'm going to back out here, escape here, and let's go down and look at a bear call spread, okay? So with an iron condor, you're also selling premium, and you want that premium. So what we're going to do is combine what's called a bear call spread with what's called a bull put spread. So by doing this, we're selling an option spread out of the money on the upside, and selling an option spread using puts out of the money on the downside. Now, if I'm doing any of these trades, a bear call spread, the options play platform has many different tools that will help you find bear call spreads on underlyings that are technically strong, or that have some volatility and some predictability, I guess is the best way to say it. But with a bear call spread, you're trying to receive the net credit. So if volatilities are high, that's a good thing when you put them on. But the downside is that you have a lot of risk, right? The reward here, the green area, is much smaller than the red area. So if you're thinking about doing a vertical spread, well, the upside of a vertical spread, or a vertical spread versus an iron condor, is that if I sell one side of the spread, I have a little bit of reward and a lot of risk. If I sell the other spread, I bring in and I get double the reward, and I get a little bit less risk. And the good news is that with an iron condor, is at expiration, the stock can only go one direction, right? The stock can only go up, or the stock can only go down. So one of the spreads has to work out. You still usually have more risk than your reward, but you have a high probability of success on that trade. Now, my issue with when I'm looking at an iron condor is that the volatility, if you're doing something around earnings, is, dare I say, maybe not worth the risk, right? So if I'm looking at an iron condor, I would rather do that in an index or in an ETF, maybe an ETF that tracks the index. A very popular underlying to do iron condors in is the SPY, the S&P 500 index that tracks the SPX. Very liquid underlying, and a medium price stock. So once again, you get some volatility, but a little bit more predictability. So if I'm looking around an earnings event, and where I have a whole bunch of volatility, I would rather do something where I'm going to capture as much of that volatility premium as I could. So I'd look more so at an iron condor extremely wide on the wings. as opposed to a butterfly that I go extremely wide on the wings. Whereas if you're looking at an iron condor, you want to in my mind, I'm going to avoid earnings. If anything, I'm only going to lean to one side on earnings because of that unknown announcement, an unknown event that could happen. So 1 second, let me stop sharing for a second, and we're going to pop out and we're going to run over to the first trade platform. And I want to look at a trade that I have set up that is an iron condor. And I want to pull up the trade and look at the profit and loss graph. And let me zoom in a little bit before I share my screen again. So here we go. Now, once again, this is not meant to be a recommendation, and we are showing real quotes. The markets are open, they're rocking and rolling. I've zoomed in a little bit on this, but if you go from the option chains to the options wizard, this is the combination of the first trade platform that we see here and the options play platform. So an underlying stock that has, been very active is, and this is part of the Spiders watch list. If we click this little drop down right here, you can see all the different watch lists that are available that track ETFs that track sectors. So recently, if we look at the ups and down moves here, and then we can even pull out a little further in time, look at the chart. Look at the type of movement that you have in the underlying stock. Now, if you going all the way back to June, right? This has traded within a range. Once it broke through here, the range has been from 85 to 88, from 85 to 88, and that lasted 1, 2, 3 months. Now we had a little bit of a breakout, and now we got a consolidation period again. So to me, this defines some volatility and some predictability. Energy is a very obvious hot topic right as of late. It has to deal a little bit with AI and stuff like that. But it's not, to me, it's not necessarily, we're not doing this to try to show this is the one trade that we want to do, right? Like I said, not meant to be a recommendation, but I want to show you the setup and how this trade can work out if you set up an advanced four-legged trade like an iron condor using live markets, right? So the options play score here is actually 100, but what I'm looking at right now, let's click trade. Let's click the trade button and let's look at the legs of the trade. So we have the underlying stock at 88.89. The range, even went back when it was in this consolidation period, was between 84 and on the high side was right around 88. So about a 4-point range throughout. 80, little less than 84 on the high side, a little higher than about 89. So we'll say 5-point range. Okay. So if you do think that this type of, and recently it's even been less actually since the beginning of the term here, and this is the XLE, this is the energy stocks, it's the spider that tracks the energy companies, and we've had even a more of a consolidation period, a little bit tighter market. Use the same type of concept, and the options play platform does this, usually goes out about 44 days when you're looking at selling premium, at selling option contracts. Stock is at 89. We're going to go 3 points up to 91, and then we're going to sell the call spread here, selling the 91 strike call, buying the 94 strike call. That's the short call spread that we were highlighting in the slides. And then on the downside, we're going to go down. We're going to look at the 84 strike and buy the 87 strike. I'm sorry, we're going to sell the 87 and buy the 84. Now, this is a call and a put spread. So we have a short call spread, which by itself is an okay trade if you are neutral to bearish on the market. But we're going to combine it with the short put spread, which means we are neutral to bullish on the marketplace. So our range is from 87 to 91. So you're talking from here to here. So overall, we have that 4-point range within where the market is at. And we need time decay to work for us. And that is the range that we are looking at on our butterfly. And because of that, we can bring in 2 credits. So we're almost at a 50-50 risk reward. We're looking at 172 is the midpoint. So the risk is $128 and the reward is $172. Why? Because we're bringing in 2 credits and we can only lose on one side of the trade. Now, the question is, do you want to have that awesome risk reward thinking that this channel will continue, or would you like to widen it a little bit? And if you have any questions on this, please do put them in the Q&A box, not in the chat box. Chat box isn't open to everybody, but just put it in the Q&A box. And here's how you can modify it very, very quickly. If we click close and we click modify this trade, you can actually just move everything by 1 strike. So in this scenario, we're on the call side, we're on the put side. We're going to go up to the 95, and we're going to put this at 92. We're going to keep the width between the strikes $3. And then on the downside, we're going to go down 1 strike to 86, and then we'll go down to 83. Now, this isn't it doesn't quite give you as high of a score on the options play platform. The other one was closer to 100, but you're also adjusting your risk. So if we click trade, the midpoint on this trade, if we could fill at the midpoint, which this is a fairly, well, actually the platform highlights that it's a very liquid. I would call it fairly liquid. I mean, the markets are okay. I think we could fill somewhere close to the midpoint. If you look at you got a 4-legged option trade, and you got the bid is 132 by 148. The midpoint is 141. So we're talking about $141 with $159 worth of risk. Almost 50-50 risk reward, staying within this channel, and we're just moving up a little bit more. And now we got a 5-point range. Actually, what is that? That's 4, 5, 6. We have a 6-point range. And let's pull in the profit and loss graph here. And now we just need that market to stay within that range. And we got a 50-50 trade. So you can't do short spreads and come up with a scenario where you have a 50-50 trade, where you're risking as much, where your risk reward is equal, right? Where it's very close to equal here. Our reward is 141, our risk is 159, almost a 50-50 bet on this trade by looking at it. Now, we can manage the trade along the way. And the way that I like to manage or adjust an iron condor is I will sometimes take off the side that's profitable. I'm expecting things to come back within the range. If I can make money on the call side of it, I can let the put side ride because I'm expecting it to come back and stay within this channel. Any questions on the iron condor or the setup? And you could even go a little wider if you wanted to. If you're going to go out to 44 days, you could go move it another point, and then that would make it 8 points wide. This underlying hasn't made that type of movement in quite some time, right? 8 point wide. It can do it tomorrow, but well, here's the gap down that we received in energy not that long ago, but a lot of news. Stuff going on in Gaza and overseas and conflicts. So anything can happen, but that's what created the big downturn in the market. All right, Oh, I see a question. How can you repeat how you would modify it to remove the put side? Okay, so if I'm modifying quite simply, quite si can you repeat how you would modify it to remove the put side? To remove. This is a question from Anonymous. Now, if I want to remove the put side of this trade, if I am, well, you just wouldn't put the call side on. I don't know if that question was asked right. Can you repeat how you would modify to remove the put side? Uh, it, if you how I modify, I'll just look at how I modified the trade, Anonymous. Uh, Obviously, that's probably not your first name, but Anonymous has that question. So let's just go back and look real quick, like how we modified the trade. So all I did was adjust the strikes. Now you can also click down here, and you can adjust the wingspan. So if you notice this graph, if I'm clicking on this, I'm getting wider. If I'm clicking on this, and notice the profit and loss graph up here, okay? So if I click on it, it just makes the wingspan wider. And if I click trade, now we got 86 to 90. Well, I think I went right back to where I was, didn't I? 86 to 92, so this is 6 points away. Let's go one more. And now, oh, we're going wider this way. We're going wider this way. 86 to 81. And then this one is going to 97. So we're adding more risk potential. So the risk reward is not going to line up to 50-50, right? Because now we're 5 points wide. Now, if I go back down here and I increase this, there we go. Now we're at 86 and 93, okay? So the wingspan and the width, you can do the width of the profit and the loss. You can adjust the middle just with a little click. Come here, you stupid thing. Okay, you can adjust the middle with a stupid click, with a simple click. And you can adjust the width, the overall risk with just a simple little click too. So you got the width between, this is the profitability, this is the risk. Okay, so now if I want to adjust it, I just remove it. I mean, I can just delete this and I can make this a short call spread. I just don't want to go back and set it all up, if that was the question. Okay, when choosing an instrument to trade iron condors, well, some volatility, some predictability. I lean towards the spiders. I lean towards the ETFs. But another way to choose is to look at anything that's going to pop up inside the credit spread. So anytime you got a underlying that has a solid credit spread that you want to look at, that also can translate into an iron condor. My only issue is I want to avoid earnings. So I want to make sure that there's no earnings that are available. I'm trying to click on the credit spread. And once again, you want some volatility and some predictability. What the spread trader is doing when it's looking at credit spreads, when it's looking at short call spreads, short put spreads, is it's looking that you're getting some premium without a ton of volatility. So, well, it's going to lean more towards getting the right amount of premium that's in the trade. So anything that pops up inside that credit spread is a decent underlying to look at. So we have PFE, this is Pfizer. To me, this would be an interesting underlying to trade in, mainly because of the marketplace. And this is where the economy is at too. So healthcare. The way that I approach it when I'm looking at iron condors is I want to look at the sectors that are struggling, if you will. Maybe you can lean it a little bit more bullish if you want to. Healthcare has done a little bit better, but it's really struggled over time. I prefer doing it in underlyings that are what was I saying? Underlyings uh, that have a little bit less volatility. Oh, like in the sector, I don't want to do it in the semiconductor sector, right? The semiconductors has and the AI uh, marketplace has driven the market higher, and that's what's really propping up the market. And to me, it's like having stimulus that happened in the COVID era, right, where the government just gave everybody money. The AI, everybody is making so many investments that's flooding the market. And to me, this is a big reason why the market is doing so well in October, which has historically been a real tough month. But once again, I don't mind this chart, right? And this comes directly from the search. We had a little bit of a move up. My only thing is we're running into earnings season, November 4th. It's 27 days away. So I would avoid that earnings if I'm looking to do the Pfizer trade. And it's a $25 underlying. So it's going to be a little bit it's going to be a little bit, it's only going to be about 2 points wide if we look to do this. But let's put one together. Let me see if we can find, is there an underlying that's got a little bit more premium in it? XLP, I don't really know that one. I'm sorry, that's an ETF that's popped up in here. I understand. AMAT, Qualcomm. I don't mind this one. Yeah, I don't want. Caterpillar, maybe. Caterpillar keeps popping up, but that's been a little bit more bullish than I'd like to think, but it's a $500 stock. Let's look at one in Caterpillar, and then we'll call it a day. I still want to go back and look at I got one trade that I want to show you on the butterfly side of things. Once again, not meant to be a recommendation, but we're getting some decent premium in Caterpillar. So let's go in and let's modify this trade. We have this is a bull, it's bullish and bullish. Yeah, the market's been bullish. 460 to 570. So we're going to be able to go wide on this. We're going to go all the way out, probably the 470 level, 30 points below. Let's modify this. And bid and ask, let's add, we're selling the put at 590. And you're going to go wider than what it says, right? We're saying we're selling the 490, buying the 460. But we don't need to be as close to the strike because we're bringing in an extra credit. So that's the way that I approach it. And that's the way that I look at the trades. All right. So if I'm doing my iron condors, I will widen them a little bit as opposed to try to bring them in tight. If I'm doing a credit spread where I'm just selling either the put credit spread or the call credit spread, otherwise known as a vertical spread, I will bring it in a little tighter because you have a scenario where you're neutral, either the market you want to, or the market could go up or the market could go way down. So you have a different alternative. On the iron condors, have a tendency to go a little wider because you're going to bring in an extra credit. Okay, I beat that dead. I beat that horse enough. Here we go. 490. So we'll bring this down to 480, 460. Net credit, 5. Yeah, that's a solid risk reward, right? You're doing about your reward is 510 and the risk is 1500, about a third of it in that instance. So we'll do that, and then we'll add. That's on the put side of things. So we need to add to calls. Add a leg. You can do it through here too, but I just like to add the leg personally, and maybe it's because of the way I set things up, or I don't know. I like to have more control than less. Okay, this is 20 points wide. We're looking at 520, 540, 480. It's almost 30. Okay, so this could be 525. Oh, we don't have the 525 in that expiration. Aha. All right, so this is going to be it. 107. See how much. Let's see where our risk reward comes in. All right, so I think I'd go a little bit wider here. We're bringing in $12.47 on this trade. So our reward is $1,247 and our risk is $730. Now, why is this a decent risk reward? Because we use the credit spread trader to try to figure out basically it's figuring out the skew of the market. It's figuring out the volatility of the market in general on that trade. Now we do have earnings on October 29th. That could be so maybe we keep it here and let's go to October 31st is a Friday. I just know that because it's Halloween. So we'll go 1 week before that and let's see what our risk reward profile comes up with. So if we avoid this earnings, and this is going to be hard to do iron condors on underlyings because of all the earnings. It is the season, as we say. So let's modify this again. And let's pull up, let's go to the 24th. This is Halloween. And we'll do that all the way across. Boom. And see if we need to adjust our strikes a little bit more. So now we're 16 days. We're avoiding that earnings. And we're at the 520 range. And let's look at the downside. We're at 480. Draw the trend lines here. $487 is where that trend line comes in. So we're at 480, which is right at the top of this little breakout area, right at the top of this doji that happened, and all the way down to 430. Yeah, I don't mind this trade. Now, I don't like that it's only 16 days out, and we just kind of put this together here. If you want to write it into earnings, you can write it into earnings, and then the risk reward gets pretty decent, right? But you want to go a little bit wider on our strikes. Our risk reward was too good on the initial one that we put out. But if you're going to avoid it, and you're thinking that we're going to go in a period of consolidation heading into the earnings, it's not a bad trade. All right, now let's go back. I'm going to close this, and I have a trade set up already in Goldman Sachs. Once again, not meant to be a recommendation, but I want to show you $788 is where the underlying is at. They announce on a Tuesday. I'm looking at going out the 14th. So we're going to go 10 days beyond this. Yeah, that's the 14th. That's right. Tuesday the 14th before the open. But now, by selling the at-the-money option contract on a stock like Goldman, right, you're going 15 points wide. That gives you a 30-point range that the underlying stock can be in. And you're looking at 95 cents here. This is the actual trading platform. You get to this by clicking on options and you click on butterfly here. And if you want to go wider, the first trade platform will adjust the strikes to keep it within the butterfly and keep it within the risk. So if we go 20 points wide, I mean, you're only looking at risking $1. And at the money option contract is trading for $23. So we're going to go here, 770, and then go up here to, oh, that should adjust it. I'm sorry, I did that wrong. Let's go 770. So then it's 20 points. See, it automatically adjusts the widths, 20 and 20. Now you're talking about $1.35. Do you think Goldman can announce earnings and stay within a 30-point range? Right? You're betting the under, right? The at-the-money option contract is trading for $23. It means the expected move is about 46. If you bought the at-the-money call, you bought the at-the-money put. This is using call options. You're going 20 points wide here and 20 points wide here. The market is almost at 790. But this is where I'm saying if I were to do something around an earnings event, I want to sell that at the money premium. I want to get as much of that premium as possible. So you could do an iron condor and try to go real wide, but then the risk is so much higher and there's an unknown event that might happen. So moral to my story is big high price underlying. I want to, as opposed to maybe selling either a call spread on the upside or selling a put spread down below the market, right? Thinking that the market can stay above that. This is an interesting alternative if that is the speculative type trade that you want to do. So you need this to stay within the range, within the expected move, but you're talking about a 40-point swing. Now the break even is going to be 810 minus 135 and 770 plus 135. So you got $2.70 minus 40. That's the range that it needs to stay in. But when you get high premium, selling at the money option contract to try to capture that premium, this is one way to do it. Butterflies are getting very popular in zero DTE options like the SPX. Some volatility, some predictability, very expensive index. So you're getting a lot of premium on that trade. And heck, you could even go a little bit wider. You're willing to spend an extra, let's say 70 cents. Let's go down to the 65. And first trade wonderfully adjusts you on this trade. Oh, not even that, 157. Now we're 60 points wide on our butterfly. All right, any questions on that? I see we're getting to time. I mean, gosh, let's see what happens if we get, this is 1024 expiration, so about 14 days to that period, 1024. Yep, that's about right, 14 days. Let's see how wide we can get. Let's go all the way down to 750. Yeah, that's too much. $8.75. I got a little egregious. 765. 195 on that. So now you're looking at 25 points, 50 points. Interesting, right? No guarantee that you could fill it at midpoint. It's a three-legged trade. It's on an underlying that's announcing earnings next week. There's going to be a lot of interest in it. A lot of people are going to be trading it. Those type of things. $450. There we go. That makes a little bit more sense. 450 after I hit that refresh. Okay, so if we go 25 points wide, 450 is yeah. Then you're getting into real money, real expense. Let's just put it that way. See where this is at. Boom, boom, boom. Yeah, 450. So I would want to go tighter and risk less on the trade. So let's bring this back. Let's go 75. Let's go back to the original. So that's 15 points, and then this is 15 points. Hit this 145. So now instead of paying to buy an at the money option or even an out of the money option, the out of the money with 805 call is trading for $15.75 on the bid. Last trade was $16. So the midpoint's right around 16 on this. Or you do this trade, expect it to be tamer, stay within the range, and you're risking $145 on the trade. All right. Any other questions? Oh, I see a Q&A. I think I've answered everything. All right, everyone. Well, I hope this was helpful. Yeah, I don't have a great answer, and that is Mario with the question like, how do I choose the instrument? And I would really just say it this way: I look for sectors, and then I look for ETFs. If I'm doing iron condors, I want to do them in the SPX and the SPY. That's a no-brainer if you want to continue to do them over and over again. But like I showed you a great example, I targeted the XLE, looking at that sector, checking out the chart, seeing what the range that it's been traded in, and then go from there. So target sectors and like to use ETFs with iron condors, which also equates to the credit spread scenario. So if you need some help finding an underlying stock that you want to trade, You can look at the options play credit spread search. Also in that search, you will see ETFs that will show up just also. So that is a little bit of a bonus inside that search. Thanks for coming. My name is Brian Overby. I am the senior options strategist over here at Options Play. My book is called The Options Playbook. If you want to check it out, you can buy it on Amazon or check out the website, optionsplaybook.com. Thanks for stopping in.